Most people spend their last few months at work doing the math on what they're owed. Final paycheck, unused PTO, and the big one, the annual bonus, maybe $20,000, maybe more. It hits in February or March, and it feels like the last reward for 4 decades of showing up. So you wait. You stay through quarter one. You collect everything on the table. That's not greed. That's just being practical. You earned it. Except, and this is the part most financial advisors won't tell you before you sign the paperwork, that single paycheck can quietly detonate your entire tax strategy for the first year of retirement. Not because you did something wrong, because the way retirement income gets stacked and taxed and clawed back operates on a completely different set of rules than your working years did. Rules that punish high income spikes, even short ones, even the kind you've technically already earned. I've sat across from families who did everything right, saved for 30 years, thought carefully about the timing, and then stayed just long enough to collect one final bonus, and unknowingly walked into a bracket that cost them more than the check was worth. The math here is brutal and it's specific. Most advisors tell you to squeeze every last dollar out of HR before you go. I used to think that too. But the numbers in 2026 tell a different story. And today I want to walk you through exactly why waiting until March to collect that $20,000 bonus can end up costing you more than that with the IRS and the Social Security Administration. If that surprises you, stick around. And if you're not subscribed yet, this is the kind of thing I cover every week. The year you retire is the strangest financial year of your life. It doesn't look like your working years. It doesn't look like your retirement years. It's a hybrid, and that hybrid is where people get hurt. Here's what actually happens when you retire in March after collecting your bonus. You come into that year with 3 months of regular salary. Call it $30,000. Then the bonus lands. Another $20,000. Then HR cuts you a check for your unused vacation days. Maybe $10,000. That's $60,000 in earned income before you've even had time to cancel your work parking pass. Now, if you also started drawing from your IRA to cover living expenses, or if you filed for Social Security early, those dollars get added to the pile too. The IRS has a name for the total. It's called your Modified Adjusted Gross Income, or MAJ. And in the year you retire, that number can spike in ways you never expected. Not because you're wealthy, but because income from 3 different sources all landed in the same 90-day window. That spike has consequences. Specifically, it triggers something called Medicare IRMAA. IRMAA stands for Income-Related Monthly Adjustment Amount. It's the surcharge the government adds to your Medicare Part B and Part D premiums when your income crosses certain thresholds. In 2026, the first penalty threshold for a single filer is roughly $106,000. If your stacked income pushes you past that number, your Medicare premiums don't just nudge up. They can jump by hundreds of dollars a month. But here's what makes IRMAA particularly frustrating. Medicare doesn't look at what you're earning right now. It looks back 2 years. The income spike from 2026, your retirement year, will follow you into 2028. That's 2 years from now when you're fully retired, living on a fixed income, and suddenly receiving a letter telling you your health insurance just got significantly more expensive. I've sat down with families going through that letter. It lands like a gut punch. They're not earning anything close to what they earned in their final working year. But the system doesn't care. It's reading a tax return from 2 years ago. Now, some of you may have already heard the workaround, Form SSA 44. A lot of YouTube videos recommend it. The pitch is simple. Retirement counts as a life-changing event. so you can appeal your IRMAA surcharge and get it reduced. That's technically true. I've filled out that form with dozens of families. But here's what those videos leave out. The SSA will reject IRMAA appeals when the income that caused the spike includes severance pay or capital gains. It's not a gray area. They will look at your 1040, identify those line items, and deny the adjustment. I've watched it happen enough times that I stopped recommending the form as a safety net. The income stack in your retirement year is real. It's predictable. And it's almost entirely avoidable, but only if you plan around the month you walk out the door. And IRMAA is only the first problem. There's a rule buried inside Social Security that most people about to retire have never heard of. And when they find out it applies to them, the reaction isn't confusion. It's anger. It's called the earnings test. Here's how it works. If you claim Social Security benefits before your full retirement age, which the SSA calls your FRA, and you're still earning income from work, the government will reduce your benefit check. Not suspend it permanently, but hold back a portion of it based on how much you earned. In 2026, the earnings limit is $24,120 for the year. For every $2 you earn above that threshold, the SSA withholds $1 from your Social Security benefits. Now think about what happens when you retire in May with a $20,000 bonus and a $10,000 PTO payout sitting on top of your regular salary. That $30,000 in extra income doesn't disappear from the SSA's calculation just because you stopped showing up to the office. It counts as earned income for the year, which means if you were already drawing Social Security, that lump sum could trigger $10,000 or more in withheld benefits, right in the first year of retirement, when your cash flow is at its most fragile. I know someone this happened to. His name was John. At least that's what he went by in the comment he left on a previous video. His wife retired at 65 in May. She had a solid final paycheck, a bonus, and several weeks of unused PTO all hit at once. A few months later, a letter arrived from the SSA. Her benefit was being reduced by $250 a month for the next year. John called the SSA to ask why. The person on the phone told him his wife should feel fortunate to be receiving benefits at all. I understand why that response felt like a slap. 40 years of FICA taxes, decades of being the financial backbone of a family, and the system responds to a reasonable question with a shrug. The withheld money does eventually come back, to be fair. Once you reach your FRA, the SSA recalculates your benefit and credits you for the months it held back. So it's not a permanent loss. But that's not really the point. The point is that in the first year of retirement, when you're adjusting to a completely new financial life, when the paycheck is gone and the portfolio has to start working, having $250 pulled out of your monthly Social Security check for 12 months is a real problem. That's $3,000 you were counting on. Gone, because a bonus cleared your bank account in May. You worked to maximize what you'd take home from your employer. The system responded by reducing what it sends you every month. That tension is the earnings test in real life, and it's entirely avoidable with a different retirement date. The income stack costs you Medicare premiums 2 years from now. The earnings test costs you Social Security cash flow right now. But neither of those is the calculation that should keep you up at night in 2026. That one involves your investment account, and the math is genuinely ruthless. Let's talk about the actual math, because this is where the bonus stops feeling like a reward and starts looking like a liability. To understand what's at stake, you need to understand one thing about 2026 that's different from any retirement year in recent memory. The Tax Cuts and Jobs Act, TCJA, expired on December 31st, 2025. That's not a future event. It already happened. And what it means for you right now is that ordinary income is taxed at higher rates than it was last year, and the standard deduction dropped significantly. Your taxable income goes up faster now, with less shelter. That matters enormously for one specific reason. In a low-income retirement year, many couples qualify for the 0% capital gains tax bracket. In 2026, that bracket phases out around $96,000 in taxable income for married couples filing jointly. If your income stays below that threshold, you can sell appreciated stock, investments you've held for years, and pay zero federal tax on the gains. Zero. That's not a loophole. That's the tax code rewarding people who manage their retirement income carefully. And it represents one of the most powerful financial tools available to someone in their first years of retirement. Here's what it looks like in practice. Say you need $100,000 to fund something real in your first year of retirement. A used RV, a home renovation you've been putting off for a decade. Whatever it is, you need liquidity. You plan to sell stock, and $50,000 of that sale represents capital gains, the profit built over years of holding. If you retire in January and skip the bonus, your earned income for the year might be $20,000 or less. Add the $50,000 in capital gains. Your total income lands around $70,000, comfortably under the $96,000 threshold. Your capital gains tax bill, $0. Now run the same scenario with the $20,000 bonus. That $20,000 gets stacked on top. Suddenly, your total income is $90,000 before the stock sale. Add $50,000 in gains, and you're at $140,000, well above the 0% threshold. The entire $50,000 in capital gains is now taxed at 15%. That's $7,500 out of pocket just from the gains alone. And then there's the bonus itself. Under the 2026 tax brackets, that $20,000 in ordinary income gets taxed as regular income at a higher rate than it would have been under CJA. After federal income tax, after potentially state tax, after the Medicare and Social Security effects we already talked about, the actual take-home value of that $20,000 bonus can fall below $10,000. You gave up the 0% capital gains window permanently for that year to net less than half the check you waited for. That's the trap. Not a complicated one, just a painful one. And the worst part isn't the $7,500 tax bill. The worst part is what you lose going forward. The first few years of retirement are typically your lowest income years. Your Social Security isn't fully optimized yet. Your required minimum distributions haven't kicked in. This window, roughly ages 60 to 72, is the best opportunity most people will ever have to harvest capital gains at 0%, do strategic Roth conversions, and reposition their portfolio at minimal tax cost. You get one retirement year, 1 year where your income is at its absolute floor. Blowing the 0% capital gains bracket in that year to collect a bonus that nets you less than half its face value is a trade-off that follows you for the next 30 years. The check from HR is not a bonus. It is a tax event dressed up as a reward. Tell me in the comments, what month are you planning to retire? And are you waiting on a bonus or PTO payout? I want to know how many of you are sitting on this decision right now. The math explains what happens. It doesn't explain why we do it anyway. Because here's the thing. Most people reading their final offer letter already sense something is off. They know the bonus is going to complicate their taxes. They've heard the phrase income stacking before, and they stay anyway. That's not a financial failure. That's a very human one. There's a pattern I've seen play out more times than I can count. Someone spends 35 years building a career inside a large organization. The salary, the title, the benefits package, these things become part of how they measure their own worth. Not consciously, just quietly, over decades. And then the day comes when they could walk out. The retirement account is funded. The mortgage is manageable. The math works. But leaving money on the table, even money that costs more than it's worth after taxes, feels like surrender. Like admitting the company got the last word. That's the sunk cost fallacy at work. The logic goes, I've already given them 35 years. I might as well get the full bonus. But the 35 years are gone either way. The only question is what you do with the next 30. There's a related pattern that shows up in the comments on almost every retirement video I post. Call it one more year syndrome. The goalposts keep moving. One more bonus cycle, one more vesting period, one more quarter to shore up the numbers. And meanwhile, the retirement date slides from January to March to October to maybe next year. I used to advise clients to stay long enough to collect everything they were owed. Squeeze every dollar out of HR before signing off. I thought that was being thorough. I was wrong. What I didn't account for was the cost of what I'll call a winter retirement. When you stay through quarter one to collect a February or March NAS bonus, you're not just collecting a check. You're retiring into the coldest, darkest stretch of the year, often exhausted from the final push, without the energy or the weather to actually begin the life you've been planning. The research on retirement satisfaction is pretty consistent on this point. People who retire in the spring report a meaningfully smoother transition than those who exit in the dead of winter. That matters more than it sounds. The first 6 months of retirement set the psychological baseline for everything that follows. Retire burned out in February, stuck inside with a complicated tax situation and a Medicare form on the kitchen table, and the transition feels like punishment. Retire in March or April with a clean income picture and a few warm months ahead of you, and the same financial life feels like freedom. The bonus check doesn't just cost you money. It costs you the version of retirement you actually wanted. Staying too long to collect a check you've already earned, and then watching that check get cut in half by taxes, Medicare surcharges, and Social Security clawbacks is not a victory lap. It's the sunk cost fallacy with a very expensive price tag. So what's the move when the time comes? The month you retire is not a calendar detail. It is a tax decision, a Medicare decision, a Social Security decision. And in 2026, with the TCJA gone and the brackets reset, it carries more financial weight than it has in years. Here is what the math actually says, stripped down. Your retirement year is the 1 year in the next 3 decades when your income can be genuinely low. No full salary, no required minimum distributions yet. Social Security not fully in motion. That window, that 1 year, is when the 0% capital gains bracket is within reach. When Roth conversions are cheap, when you have the most control over your tax picture that you will ever have again. Blowing that window to net $8,000 or $9,000 after taxes from a $20,000 bonus is not a financial strategy. It is a habit. The habit of an accumulator who hasn't yet made the switch to thinking like someone who is now managing a distribution. That switch is the whole game. It means the goal is no longer to maximize what comes in. It means learning to control what shows up on line 11 of your 1040. It means understanding that a lower income year, managed well, is worth more than a higher income year that triggers Medicare surcharges 2 years from now, withholds Social Security benefits today, and closes the door on tax-free capital gains permanently. The system is not neutral. It is designed around thresholds, look-back periods, and income definitions that reward people who plan their exit carefully and quietly penalize those who don't. You spent 40 years feeding that system. You have every right to understand how it works on the way out. I've watched people navigate this well. They retired in January or early February. They left the bonus on the table or negotiated it differently. They sold appreciated stock at 0%. They converted a chunk of their IRA to Roth at a low rate. And they started retirement with a tax return that looked completely different from anything they'd filed in their working years, in the best possible way. That outcome is available to you. It requires making one decision that feels counterintuitive, choosing a smaller paycheck from your employer so the rest of your financial life can breathe. If this is the kind of planning you want to keep doing, not the general advice, but the specific math behind the decisions that actually move the needle in 2026, subscribe to the channel. This is what we work through every week. You've built the foundation. Now learn the rules of the game you're actually playing. Go enjoy your retirement.